Remind you at the end, but just a heads up that any CPAs can get CPE today. Another note is that we're going to have a question and answer session after the panelists each give their talk. So we'll have a few minutes saved, and Nick Stevens will come up and be able to handle that, and we'll pass the mic around to the panelists as necessary to answer any of your questions. So be thinking of that as the panelists give their insights to us today. And so at this time, I want to introduce the panelists that we have for you today. So we've got Russell Rhoads, who's going to be talking about national and international economies. We got Ryan Brewer talking about the financial markets. We've got Tim Slaper coming and talking about Indiana economics. And then Mayor Dean Vonderheide, we're thankful to have him this year as well to be talking about the state of the local economy and what he's seeing in the area. So at this time, I'd like to introduce Russell Rhoads to come up and begin.
Thank you. I thought I was going to be able to work with two hands here, but I'm not going to be able to. So I'm going to talk about the U.S. economy and a little bit about the international economy. In addition to being a professor at Indiana, I'm head of research for a firm called EQ Derivatives, and we deal with pretty much all the central banks in the world. So some of the things I'll say draw from that as opposed to the IU outlook. We've been polling economists, and you should hear the loud sigh on the phone when we say, so what are you thinking about in 2023? They don't want to write a forecast. They don't even want to talk about 2023. The last time it seemed like there was this much uncertainty going into a year might have been 2017 going into 2018. Right now, output growth in the US, it's running at about 1.8%. We were expecting 4%, but which is what we were expecting in last year's outlook. The slower growth, it's really showing up in consumer spending and business investments. This next line just makes me pause. There was negative growth in housing. We expect that. Anybody want to guess what the other negative growth in spending in 2022 was? Mayor? Government spending. I got to go check that number. I just can't believe that there was negative growth in government purchase. The labor market is very solid. Unemployment rate, we're at 3.7%. That's where we were at the pre-pandemic low. Needless to say, inflation was starting to appear this time last year. Last year when we did these, I was at the first one and the last one. The first one was in Indianapolis, and I said, who's a little worried about inflation? And to be honest with you, I've been worried about inflation for about a decade, so I was very early. But at the Indianapolis meeting, it might have been 3 out of 50 people in the room. By the time I got to the last meeting, about half the room was worried about inflation. The point behind that is things can turn very quickly. And we saw that last week as well. We got a relatively weak CPI number, although I think if I told you this time last year that a 7.7% CPI number was going to result in the stock market rallying, you all would have not come back the following year to hear from us. Needless, like I said, inflation's been a big issue. We continue to hear comparisons with inflation in the 70s. Do keep in mind that the first inflation spike in the 70s happened in, I think, 74. And then the one that we all hear about, that Volcker had to raise the rate, that we ended up with 14% mortgages, which we were talking about at the table, that didn't occur till the late 70s. So this may be the beginning of an extended inflation period. Not to be, and this thing here is for me to hide behind as I go through the potential bad news. Just keep in mind that first inflation spike was followed, it reappeared after a lull toward the end of that decade. Right now, the financial markets, one of the things that I like to focus on is the derivative markets can give us an idea of what the market expects the Fed to do. And I think this is better than just some random opinion. Before the CPI number last week, the derivative markets were expecting a 5.5% Fed funds rate by about the third quarter. That dropped to 5%, and that's one of the reasons the stock market rallied as much as it did last week on that CPI number. As far as, this is the real hard part here, the outlook for next year. What we've decided to do is have an optimistic and a pessimistic scenario and give you a range of outlooks. Output growth, we're looking on the optimistic side, up 1 to 1.5%. On the pessimistic side, maybe a couple of quarters of 2% contraction. That would definitely be a recession. Unemployment, right now, as I mentioned, we're at 3.7%. The best case scenarios, we expect mid-year for for unemployment to peak around 4.5%. If we do end up in a pessimistic scenario, by the end of next year, maybe around 6.5%. We expect inflation to increase by about 800,000 in a positive environment, and possibly a decrease of 3 million in a negative environment. Some factors to focus in on looking into next year. Interestingly, goods consumption right now is about a little over 15% higher than pre-pandemic levels. Services is only 3.4%. So if we get back in balance with those two things, that means people will be spending more money on services and less money on goods. In fact, I heard a retail analyst yesterday say that she expected people to spend more money on gathering at the holidays than buying stuff at the holidays, because we're all want to see our loved ones, and I think that goes along with this right here. The problem is for goods producers, even a small contraction in sales in the current environment, that could put us into a recession as well. Savings had increased from 2019 to 2021 by about $2 trillion. That number has fallen off by about a third in 2022. People dipping into their savings is one of the things that has allowed us to maintain some growth. But we got to take into account how much longer consumers will use their savings in face of higher interest rates and inflation. And always keep in mind, consumption is very important to the U.S. economy. It's 2/3 of the U.S. economy. As far as the labor market goes, this one's pretty interesting. The labor market participation rate is 1.2% lower than it was before the pandemic. And it sounds like a really small number, but that's 3 million people. That's the participation rate doesn't really appear to be improving. So we've got a systematic shortage of labor. We were debating this one up at the table, and what industry maybe we don't have a shortage of labor. It's probably the IT industry. That's where we're seeing a lot of layoffs, but those folks aren't hiring right now. The shortage of labor, it's very possible this is going to push us into a second round of inflationary pressures. Internationally, Ukraine, that's about all, that's it. No, Ukraine, it's either going to get worse. If it does get worse, nothing else is really going to matter as far as the global economy goes. If we take that one off the table, you do have to look at central banks, which have held rates close to zero over the past few years. And a return to normal levels is increasing the risk for a lot of economies. And you could say that the recent situation in the UK is a good example of some of the landmines that different economies are going to have to overcome. Just a couple of international numbers, and then I'll pass it off. We are expecting advanced economies to grow 1.3% in 2023. Emerging economies, we're looking for 3.9% growth in 2023. Do keep in mind, China still counts as an emerging market. So that's probably what's pulling that one higher. And then we expect global output in 2023 to grow at about 2.7%. And I'll be waiting on your questions after everybody speaks. I'll start them for you.
You don't need to. Thanks, Russell. Good morning, everybody. So my name is Ryan Brewer, and I'll be doing the financial markets overview and what we can expect for 2023. And I think, as Russell mentioned, it's pretty tough this year to kind of look through the windshield through this fog to see what's going to happen in the future, but we're going to do our best. One of the most dangerous things that you can think, I think, as an economist or as a financial economist, is that things are different now than they were before. At some point in history, you can probably look back and find some similarities. Russell was mentioning the 1970s. I've heard also mentions about the 1990 time frame and other comparisons. But what's universal about it is that the comparisons are always to a recessionary period. And talking about sports for a second, the Philadelphia Phillies were in the World Series, and the bad news there was if they had won the World Series, I think they were up 2-1 at some point. Every time they win the World Series, we enter a recession. So the Astros rallied, giving us hope that we will not enter into a recession. But the question is, did the Astros cheat again? No. So we're late in an economic cycle, that much is true. We have historically low unemployment rate, we have high inflation, the Fed is raising rates. We're not likely in a recession today, but we probably will be in a recession, at least a technical one, in the next 3 to 6 months, maybe 9 months. The question is it gonna be like a mild recession, barely below 0%, or is it gonna be a severe recession, right? It's kind of a coin flip. So the Fed is at war with inflation, and they're using their monetary hammer. And so one of two things is gonna happen. They're either gonna break the labor market or they're gonna break inflation. The question is, which one's gonna break first? When unemployment ticks up, we end up in a recession later. During recessions, we typically lose jobs. This year so far, the U.S. has created about 3 million jobs, so it doesn't seem to be recessionary yet. So there's so much to talk about. I'm just gonna keep talking about sports for a second. We'll just move back over there. So first I'd like to do is thank Jeff Saturday, and I'll tell you why. It's not for the Colts' last second win last Sunday, although that was a fantastic start to his coaching career in the NFL. But it does bring us back to the Peyton Manning days, when winning was the way that we did things. Wasn't that great, the good old days? The Colts would win. And you know, by the way, Peyton Manning hosted the CMA Awards recently. You may have seen that. And it kind of reminded me of the movie Coal Miner's Daughter, where you had Sissy Spacek and you had Tommy Lee Jones. And Tommy Lee Jones entered into a Jeep climb contest. You might remember that. I don't remember who won, so if you haven't seen the movie, I won't spoil it for you. But what's true about it is the higher you climb up the hill in your Jeep, the harder each foot of altitude is to achieve, just like fighting inflation. Getting from 9 to 7% is relatively easy. From 7% down to 5% will be more difficult for the Fed to achieve. And for 5% down to the required or desired 2% is gonna be the hardest. So we're in for a fight. And again, the question is the Fed gonna break the labor market, or is the Fed gonna break inflation? We hope inflation, right? So thank you, Jeff Saturday, for that metaphor, and thank you for Sunday's excellent win. Go Colts, I hope they can beat the Eagles, we'll see. And talking about Peyton Manning, that's another metaphor. It was like 12 years or 13 years of monetary stimulus with the Colts. It was like Colts stimulus with Peyton Manning for 12 years. Well, we kind of got used to that. And so here's what we've had since the Great Recession. We've had 12 or 13 years of monetary stimulus. We've had, then the pandemic happened in 19. We had supply chain issues that raised prices in 2020 and 2021, although they're potentially smoothing out. There's no more reports of cargo ships in the ocean now floating around. But we did have those, and it did spike prices. We had fiscal stimulus to add more gasoline to the fire in 20 and 21. We have a tight labor market that we've both covered now. And then we had, in early this year, an international energy disruption and food disruption with the war in Ukraine. And that's led to wage increases of about 5%, and those tend to be stickier than other kinds of inflation, which if you have gasoline and milk, for instance, and turkeys, they go up and down in price. But wages, when they go up, they tend to stay there. So the Fed's at war with inflation, and the funds rate's increasing. It's gone up 375 basis points so far, and as Russell mentioned, I think financial economists are thinking 5% is a decent estimation. There's definitely going to try to cool the economy, and it's a balancing act because we want people to spend, but not too much. 2/3 of our economy is on consumer spending, so we need people to spend, but again, just not too much. So when I think about investments, I think about 3 key questions as we think about our portfolios and how we can rebalance them in this murky environment. Question 1, at what level will the Fed funds rate peak? 5% is a decent guess. It could go higher if inflation proves to be tougher to beat down. Question number 2 is, when will we see the Fed's fund rate peak? Is it going to happen in March? Hopefully, that would be nice, February or March. Earlier would be better. If we can continue to see reports of inflation coming down like we saw last week, we will continue to get more confirmation. Right now, we just have one data point. It's not necessarily confirming. Although, according to Russell's information, financial economists and financial analysts are in belief that maybe the expectations of inflation are going to lessen. That's good news. And then the other question is, how long is the Fed going to keep the funds rate high? How long are they going to pause before they bring it back down? Those 3 questions are going to guide us for our portfolio rebalancing. So what are the options? Again, when you think about the Colts back in the, in the days of Peyton Manning, they basically had, they had two options. They had Peyton Manning, Marvin Harrison, and they had the edge. That's what they had. They didn't really have defense. They didn't need that. So that's defense is analogous to bonds now, because bonds now are actually back on the table. You can get a real rate of return, well, not real rate, but you can get 4 to 6% in bonds now for the first time in a very long time. So that's a possibility as you rebalance portfolios to consider putting some of your money into some bond funds. Tech is a maybe, and the reason why I say that, if you look at Amazon and Tesla, they're down more than 40% this year, which means how much farther down can they go? Well, the answer is they could go a lot farther down. I mean, companies go bankrupt all the time. But are we closer to the bottom than we are to the crest when we come back again? So I'll say tech is a maybe, because if it goes down more, but it's going to come back higher, depends on your investment horizon. So you want to think about that carefully. Commercial real estate. Working from home is a thing. We now have reports of 50% occupancy for commercial real estate across the country. And I think with commercial real estate, it's going to depend on whether those assets can be repurposed to serve something else like condos, apartments, other kinds of businesses that are going to be walking traffic. If you have commercial real estate that's far away from a city center, it's probably less optimistic. Residential real estate, wait if you can. Mortgage rates are now 6 to 7%. So if you don't need to buy a house, don't do it. Durable goods is probably a no. We're expecting durable goods pressure to continue on through 2023. So for at least a while, you want to think carefully about durable goods. There are a few exceptions to that. I think in trucking, there's some indications that you might, look at some trucking companies or some shipping companies. They might be doing okay. But other than that, I would stay away from durable goods. Biotech, pharma, okay. Energy, probably okay. Utilities, maybe a little bit. They're high priced right now, so you want to be careful. Retailers is going to be, you want to choose ones that are more recession proof, more, less cyclical, more defensive. So think Dollar General, think Walmart. Maybe stay away from the higher priced options for a while. Consumer staples would be a good place to go. Here's one, and it kind of starts talking about crypto a little bit. Art. I think art is possibly a good place to go. When you talk about art and you talk about things like crypto and these non-traditional stores of value, crypto really doesn't have intrinsic value. Long ago, I did my dissertation on the topic of intrinsic value. And I think about crypto, people try to talk me into it, and it doesn't really have a fundamental utility basis. And there are others who will disagree, but I'm not one of them. I'd stay away from crypto. I'd be very careful about that. Obviously, what happened with FTX recently may be the tip of the iceberg. We don't know. But there's also a generational gap in terms of who seems to be wanting to invest in these kinds of alternate currencies that are not backed by a nation state. So be careful about that. Let's see what else we got. The final one I would talk about would be the socially environmental companies. And for a long time, I think people have been talking about energy and what we're going to do with fossil fuels and when we're going to finally switch over to a more sustainable way of creating value on this planet. 2008 was too early. Timing is everything with this stuff. It still might be too early, but for instance, there is a new company that just started in Scottsburg. They just employed 135 people, and their focus is on environmental sustainability and environmental energy. So that could be an option that's a long haul type option that maybe the Gen Zers are happy with and they can have in their portfolio and have some actual utility with it. So on that note, I think I've talked long enough, and I thank you for your time. I'll now turn it over to Dr. Tim Slaper for the statement.
Good afternoon. We're in the afternoon now, aren't we? Okay. I have a sinus infection, so don't freak out, but I might have to clear my throat here. So I don't know how many people here have heard of Steven Pinker, Harvard prof. And I was listening to one of his books on the way here, and he pointed out that those who give bad news are usually associated with being a prophet. If you give good news, you're associated with someone that's trying to sell you something. I'm not going to try and sell you anything. And I hope that without bad news, you'll still consider me or us a prophet. Okay. So if you look on your little sheet on the table, you'll notice what our forecast, potential forecast is for this so-called growth recession. We'll talk about that in a second. No, I won't. I'll talk it right now. That's a term from the 1970s. And when I saw this kind of percolating up, I thought, oh boy, that was fun. The 70s, we had a lot of dislocations and all the rest of it associated with OPEC and all the rest of it. So that, that didn't give me a great deal of confidence. And then I looked at what our forecast was for GDP growth, and it's something like a bracket around 1.8% on the high side and negative almost 2% on the downside. That's quite a spread, and it kind of gives you a sense of the fact that we are navigating in uncharted waters, and we talk about gaining jobs, for example, job growth, but if you consider what the base is on that, we lost a lot of jobs during COVID, a lot of jobs in the hospitality industries, accommodation, restaurants, and all the rest of it. So we can continue to have relatively rosy increases in employment, but we're still not back to where we were in terms of who's working. And some of this is what I would call sideline infraction. That doesn't happen very much in the NFL, but many of you, I bet, have gone to a high school football game, and there are plenty of sideline infractions. And by that I mean there are a lot of people in the labor force that are on the sidelines, and they just are not participating, whether it's working at restaurants or whether it's working at a tool and die shop. Across the board, there are a lot of folks that are on the sidelines. And I'm trying to figure this out, because is this just a matter of we still have the overhang in terms of people who are depressed about COVID? I'm not exactly sure, but I'm going to give you a quick anecdote. I went into a chicken restaurant called Chicken Salad Chick. How many people have heard of that? Okay. And I walked in, and they had a lot of guts. They started their establishment like a block away from Chick-fil-A. So we're talking some chutzpah right there, all right? So, I walk in, I said, can I talk to the manager for a second, please? Because last week I went to a fast food place, and it took me an hour and 15 minutes from when I walked in to actually get my meal, because there were only 2 people in the entire place working. So the person was working the cashier as well as putting together the sandwiches and all the rest of it. And I said, your place is really fully staffed. And he says, actually, we're overstaffed. And I go, excuse me? And I said, well, it looks to me like Chick-fil-A is overstaffed as well. And, oh, yeah, they are. And I said, why? Well, 1, they get Sundays off. 2, we treat our people really well. Chick-fil-A also does the same thing. And it made me wonder if some of this isn't a cultural thing where people just want a little bit more respect, even those that are working, bottom of the ladder jobs. So it's something to consider, I think, in terms of recalibrating our corporate culture, wherever it is that we're working, where there's that respect. There's that thing that, well, I don't have to work every other Sunday, or not be appreciated. So there's a little opinionation going on there, I guess, in my speech here. So growth recession, we talked a little bit just now about low labor force participation rates. And I think the previous panelists have mentioned the nature of the recession that we're expecting is going to be harder for those that are in the durable goods. So cars, for example. Business investment in terms of, say, furniture, for example, are going to be harder hit because of higher interest rates. On the other hand, those manufacturers of pharmaceuticals, medical devices, people still get sick. So that's going to act as something of a cushion for the regional economies around those places that specialize in the life sciences. Looking forward into rather than what's going to happen in March of next year, but what's going to happen in March of 5 years forward, I think is something that we need to wrestle with in Indiana. I was talking with Dean, and it sounds like Jasper does a pretty great job of coordinating with Vincennes University in terms of training workers and all the rest of it, attracting folks like engineers from, because of the cost of living. There are a lot of environmental amenities here. You're very fortunate that way. And that's attractive, especially for those that, are engineers with families. So the challenge for Indiana is to move from a very kind of team assembly, occupationally based economy to those that have higher skills, higher education, higher qualifications. And this might be junior college, might be vocational ed, maybe going to university. But the more advanced skills for the more tech integrated manual work of production that is going to likely go into the future. I did a recent analysis on occupational trends in the state. And most of the jobs, when you count actual number of jobs, it's services, accommodation, hospitality, things like that. One stuck out. One was business operations. And I looked at the US proportion of those that are in that occupation versus Indiana. And it's about 3% for the US. It's 1.8% for Indiana. This is a growing occupation in the country, and it's not a growing occupation in the state. That's kind of a red flag that we need to both educate, recruit, retain that sort of talent in the future, because that is kind of the more technically demanding set of occupations, and we're not on the right side of that growth curve, if you will. So one of the things that a certain Richard Florida, how many folks have heard of Richard Florida in the creative class? All right, not too many. He's a prof that has done research on what he calls the creative class. And the creative class means not only musicians and artists, but it also means engineers, mathematicians, those that do a lot of perhaps like mathematical design, as well as those that are doing physical design. But those are the places that tend to grow. And he called out Nashville, Tennessee as a talent hub, basically poaching folks from the west, from the coasts. And I can't say we can claim that sort of attraction in Indiana. Arguably, Jasper could be attracting that kind of talent, but it kind of shows where we're at a relative disadvantage, and something that we need to be cognizant of as we go forward. So, like several of our other colleagues, the need to attract talent, I think, is one of our greatest challenges, not just for March or April of next year, but into the mid-term future. Thank you.
This ought to be very easy because you live it. You know, our local economy is something you live in every day, and I just want to start out saying that as a county, as a region, there's more going on today than I've seen in my lifetime. And I think that's a testimonial to, one, our perseverance as entrepreneurs out here, as business leaders, and what you're trying to do to keep your businesses healthy. I show this slide because the Impact Jasper comprehensive plan was put together by our community, and it is our playbook. Now, do we have to change? Do we have to call an audible? You bet. You know, what we put in print a few years ago is nearing obsolescence. We need to come up with some new plays, and we're getting ready to attack that in the next year or two. But it has given us a good format to go forward. And our local economy, I don't know how to explain it, chaotic. You know, I think we're good. We thrive on chaos. Go back to the old days, you know. It's one of those situations where, as I explained earlier, our backs were against the wall, trying to figure out our talent, where we're going to get our talent from. One of our biggest issues is attracting talent to this area because we were growing. All of our businesses were growing. And what do we have to pull them with? You know, we don't have the amenities that we have in the urban areas, you know, but we have some things that are pretty unique to attract talent here. There are some investments that we've been making, and I think we're going to continue to make those. But our local economy is really fostered around attracting people to not only work here, but to live here. Derek, would you mind moving to the next one? So this slide kind of shows a breakdown of what our labor shed is for the county and where we pull it from to fulfill the jobs that we have. And when you think about that, we got about 60% of the employment in Dubois County is with residents. The other is in the surrounding counties, even down to Vanderbilt County. I know some people that have traveled from Illinois to work here. But what that does, that creates an opportunity. That's a lot of discretionary spend that leaves our area and goes somewhere else to hit those retail markets, to hit those restaurants and support those restaurants. You know, during the day they may be here during night shift, but then they pack up and they leave and they take their money with them. You know, this is an opportunity for us to recruit, to create an environment where we can pull them in. Now, if you go to the next one, please. So, quality of life's got to be it. And I can throw all the amenities out there, but unless I have a place for them to move to, and Gary smiles here, the housing market, a little tight, has been for quite a while. We need housing, and we need housing that is going to be inviting to those that are entering the labor market, that are established in our profession and willing to make a move and temporarily come into a unit, whether it's a condominium or a two-bedroom apartment or even a single efficiency apartment. We need housing to be able to attract talent. And so many times we don't have that available when we do have someone that we'd like to bring in. And I hear that constantly from all the businesses here. So housing is on the top of the list. When we look at the existing environment, and you mentioned who's in the labor market, there's a bunch that aren't. And they've decided that daycare is something that they can stay at home and we'll just provide it ourselves. Because that difference in what it was going to cost me to have someone providing daycare for my children and me going to work is so little. I think the value is my influence on my children. We need to get those people back to work and in the workforce. And daycare facilities, we have some great ones out there, but we are well below what the market demand is right now. And well below, again, to attract talent from outside the area. So daycare is a big deal. we have the Tim Clark Cultural Center. That's a great facility. It's become an icon for the community. People love the fact that our library and our arts are something we value. Our educational facilities with the elementary school, the high schools, the middle schools, Vincennes University, Jasper Center. And we mentioned we collaborate pretty well today. We did that when our backs were up against the walls and we're trying to figure out solutions to get talent in here. And so we work with universities, whether it's Vincennes or Ivy Tech or Indiana State, any of the universities around us. They're willing to work with us as we collaborate and identify we really need this kind of training. And I know the CAP program out of Vincennes University has been just a wonderful asset for local industry. Christian, you guys are doing a good job in listening and trying to bring these things forward. And I think that's that collaboration is the way we survive these kind of challenges out there with labor. But we've got to provide recreation. And I think we do a pretty good job of that, even though what's the one thing you hear from your children? There's nothing to do, right? But if you really took an inventory of what there is in our communities, there's a lot to do. We just have to market it. We have to get it out in front of them. We have to introduce them to some of the activities that are available today. And we need to supplement that with new facilities and environments to where they can congregate and socialize. That's a need. What I continue to hear from talent that is moving here, and I used to hear that it was very difficult to assimilate in the Jasper, to break the Jasper barrier. I don't hear that as much anymore. When I talk to people that have moved here recently, how do you like it? I can't believe it. This is a hidden gem. And so from that standpoint, we need to continue to bring these people in to help them understand what is available to them. And continuing education, education for their children, their families, just a good quality of life. And that is the number one thing we have to sell here. When you ask me how the local economy is doing, we're still growing. And all indications are every rental unit that's going up right now, every house, we've got high demand for people to move into our area. We need to have probably more density of our housing so that we can focus on the local retail and help them. It doesn't do us a lot of, it helps. But I like to see our local retail having first stab at our discretionary spend rather than the big box stores that take their money and ship it off to somewhere else. They don't play in our neighborhoods very well and sponsor the teams that are out there that these local retail and restaurants do. So I'm a fan of buying local, but I also think that we've got to be very competitive in how we compete locally with the retail, restaurants, in our local industries. It's different than it is somewhere else because we're different. We're very competitive. And just look around, we're very competitive. And for competitors to pull together to try to get some of the things that we need as far as training and education, hats off. I think we've got a good-looking future ahead of us. I'll go to the next slide, please. Since I put it together, I want to show it to you. I could talk about quality of life all day, but I'm going to cut it short here. We've had a lot of restaurants close, but we've also got a lot of new restaurants this year. And I think you're going to have some of that churn out there. That's not unusual in a business environment. Now, this year, it's been pretty hectic, but we're moving. A couple of years ago, we started doing the food trucks, the events, the downtown chowdown, in order to bring in something that maybe the community didn't have before. Several of those have resulted in brick and mortar restaurants. So getting a start, testing the market. Who else is testing the market? Of course, Chick-fil-A, the number one out there on Schrader Park. Whenever you want to go get a Chick-fil-A, and you know where they're in town when you drive by and the line's out to the road. But we'll see. We'll see if they ever do a brick and mortar here. They, from the results they're getting from their test markets, I'd say they're pretty interested. But we'll see. The next one. And then our permits. Our building permits are a pretty good indicator, I think, as to what's going on. And you see here that single-family units for 2022 was only 29. I would have expected more than that, but 29 single-family units and then multifamily units 52. We had been averaging about 100 residential units a year. We need to double and triple that to meet our demand. If you looked at what the housing study was several years ago, I know Ed, you're in here, and we talked about it this morning. We need to redo that, because as soon as we had those numbers in hand, they were obsolete. The demand continued to increase, and if we were hitting those numbers today, we're still behind by as much as we were back then. That's a good sign. Again, we are a hidden gem. It's a little tough to get to Jasper, Indiana, to Dubois County. But when you do, it's a good place to land and to be a part of. So I'm optimistic about our future. Of course, I would be. And I think with what's going on and all the collaboration and the support we get in the community, it's nothing but, it's not smooth sailing. There's some rough seas. But I think it's a lot of progress. So thank you.
Again, thank you to the entire panelists and for what you presented today. Good information. Again, not always every part of it what we want to hear, but we understand the world we live in. Couple things here before we get into the questions, asking questions. For those interested in learning more about Rotary or about getting the CPE credits, Joyce will be back in the back of the room here in just a few minutes afterwards. Please get with her and we will go from there. Questions? Anybody have any questions for any of our panelists?
I'm going to be the first one. Okay. So my question, I'm sure there was a little shudder when you said don't buy a house now, because it's in the lending business, and Gary Schnell, they had like a little mini panic attack, and the rest of the mortgage people in the room, a lot of finance colleagues here. The question becomes, when do we? If now is not a good time, when do we begin to invest or purchase residential real estate? Thank you.
That's a good question. I knew that was going to happen once he started talking about building permits. So, first of all, I apologize, being the messenger of bad news. What I would say is that if we just got so used, so low, that financing a house, especially as a first-time buyer, almost, I don't remember really the early 2000s when rates were where they are now, and they were 5-7% at some point, not too distant in the past. It's just been a while, I forgot. You get used to it. But the second thing is that during the pandemic, very surprised, at least I was surprised, and Russell, you might have a different opinion on this, but I didn't know what housing was going to do at the beginning when this thing first started erupting on the scene in the holiday season 3 years ago. And I bought a house, but people thought I was out of my mind. It was an estate sale, and I got it, and it turned out to be like one of the most brilliant financial decisions I've ever made. So of course, I privately, to my friends who are not here, brag about how brilliant I am. It's complete luck. But the truth is, you never know how these things are going to go. Okay, so if you already have a house and you're going to make a trade, I don't think rates are going to stay up very high
very long. But that's a guess, okay? That's speculation. They might. And if it's the 70s again, then it will, right? And we're just in the beginning of this. But if it's the 90s, then we'll get through it. You know, hopefully the Fed will beat inflation down. We'll be better off next year, which I think inflation seems to be the case. This is seemingly, inflation seems to be going, expectations are dropping. So you can refinance in a year or two, right? And keep getting a better rate. But the pricing action has also been surprising. So if you have a house, you're gonna trade, that's okay. It's just entering the market right now, it's kind of a new normal. And Russell, you might have some thoughts on this too, but before I stop here, I did mention two things. One, diversify your portfolio. That's important. So if you heard me say anything, diversify right now is very important. Two, with respect to tech stocks and other cyclical stocks, the train leaves the station at an unknown date and time. If you're not on the train, you missed it. That's it. So Russell, you have any thoughts on real estate?
Thoughts on real estate? I'm in the market for a house. Seriously, I was in Chicago until last school year, and then I started working in Indiana. And I rent right now in the place. I wish I had some pictures to show you guys how awful this apartment is. It's under $1,000. It's in a building that was built in the late 1800s, and I just don't want to be there anymore. So I'm in the market for a condo, and my intent is, prices are coming down, but I totally plan on refinancing at lower rates at some point in the future as well. The trading house is the difficult part, because even if you make an even trade for a house and you get a different mortgage, your home payments are going to go up. Your housing payments are going to go up. So that one's kind of tough. I actually think it's not so bad for first-time home buyers, as long as they can afford what they have to pay right now. Don't get an adjustable rate mortgage or a balloon or any of those things, but know that at some point interest rates will come down and you'll be able to refinance at a lower rate. Does that help you with your business? Okay, good.
You're going in the right direction.
Okay.
Any other questions? I was I moved here 5 years ago, bought a house 2 years ago, and had 25 days still. And so now in my neighborhood, houses are selling. The problem I'm seeing is that the house has gone up almost 40 to 50%. The rates have gone from 2 5 days to 7. And so when I looked at the estimated payment, it's 20% down. It's $500 more a month for the same house I just bought 2 years ago. And I got a friend who works in the bank in town. He told me they turn down 90% plus of every person that walks in because the income in Jasper doesn't cover the average.
I think you were talking about this opportunity. This is what I think we're saying, is that the Indiana lags behind much of the rest of the nation in terms of the really high growth occupational opportunities. When new types of technologies move in, they typically don't come here. And what can we do to help change that around and make Indiana a more attractive place for higher wage type opportunities, to where the cost of a house isn't going to repel somebody from moving into the community.
This is such a loaded question, so forgive me. Are we still adjusting based on the pandemic and the disruptions there? Because like everything seems to be related, and I realize sometimes the effects that were happening 2 years ago may not have the same effect, but it just appears to me a lot of the supply chain issues, a lot of the problems with getting tech or electronics out of China, because they still, they do crazy lockdowns. I mean, they lock down the whole town, and the town may have 500,000 people in it, but they don't care. So it just changed. I just keep thinking, are we still getting that ripple effect, or do you feel like that wave has crested and gone down?
I totally think that we're still dealing with that. And when you said 500,000 people, 500,000 people in China is a village.
I mean, they're shutting down. I've got former students that I'm still in communications with. You know, Shanghai has 25 million people, and I think it's a double-digit percentage of the Chinese economy, and they just shut that down for 2 or 3 weeks. One of the things underlying, and to answer your question, I want to talk about China a little bit more. We do still have supply chain issues coming out of China. You see big companies like Apple shifting over. Personally, and you know what, I'm not a registered rep. I'm investing in Vietnam because I think Vietnam's going to take up a lot of slack from China, and already is taking up a lot of slack from China. But they're starting to take actions that make it look like they're going to do away with this zero COVID policy, and they are starting to import vaccines as well. So one of the reasons that we've gotten the strength that we've gotten out of the stock market, everybody's talking about the CPI number, but also it looks like China will reopen in 2023, and people are taking that as up as well. I think one of the Chinese indices was up like 14% in a day last week based on all of this. So, yeah, it's still there, but I think it's going to go away next year.
One question. Okay, there you go.
I got another one. Reshoring. In economic development, you know, there was always that, if we could just get a lot of the companies to come back and they wouldn't be investing out overseas and they would, you know, create more jobs, more high-tech jobs here. We've seen reshoring, but I don't know that it's as big a wave as everybody thinks. What's your finding on reshoring, and has it really had the effect on the economy that we're all hoping that it will?
I think my favorite example on that one, and I will pass it. My favorite example on that one was when we all needed the N95 masks and nobody produced them in the U.S. and a reporter talked to a gentleman in Texas that ran a company that used to do it. And he said, I'm not going to ramp that back up because in 9 months, China's going to start selling to us again, and then I'm going to have to fire everybody and go. So I think there's a lack of confidence that if you reshore, that you're not going to have to turn around and do the opposite at some point in the future. That being said, I think some things that are being done to help bring the semiconductor industry back to the U.S., which we've suddenly discovered is critically important. If you feel like the government's got your back, you're going to be willing to reshore.
On that point, I think Apple did contract with a firm out of Arizona to get some chips just recently. So yeah, I agree with everything you said. And I also agree with the question. I think it's, you know, there is a reshoring component to the supply chain changes, but probably not as big of a wave as we'd expected. It certainly should help Indiana overall. It can't hurt. I think reshoring is definitely going to happen to some degree, but there are other places too that supply chains will go to internationally that will also kind of smooth out reliance on one place.
And if you don't mind me chiming in on this, I think there is another driver of what might look like reshoring, but it would be actually new investments in plant equipment associated with electric vehicles. And when I say electric vehicles, I'm talking about battery electric vehicles, not hybrid. Because even now, the auto manufacturers are trying to figure out their battery strategy. General Motors has one strategy. Ford tried to get in front of the EV with their Lightning, but I don't think they have as integrated a strategy on that front. But what will occur is assembly plants, many, you know, Ford, Chrysler, or whatever it's called now, I forget, will be converted to assembly for EVs. But what will occur, because those battery packs are like 12 to 1,500 pounds, they're a real pain in the neck to move. They will likely be built or supplying within 10 miles of whatever plant it is that is the preferred assembly plant. And that'll create new opportunities basically for onshoring the equivalent sort of parts and all that may have been done elsewhere, whether it's Canada, Mexico, China, or elsewhere. So you kind of have that countervailing element that is exclusive of reshoring, but kind of will feel like reshoring in many respects, I would think. And that's another thing.
Again, Joyce is in the back there. I'll have her stand and wave. And again, want to thank everybody for your attendance today and all your questions. Thank you to our expert panel for sharing their insights into the future. I hope that you guys have a great rest of the week. Consider attending future Rotary events and serving to change lives. I always leave with my little tag is don't have a good day, have a great day. Thank you.